Stocks trade ranged ahead of the weekend amid several developments in the West, the Middle East and China. Metals and IT lead even as realty and financials drag in trade.
Accenture reports a strong fourth quarter numbers and guides for 3 to 6% growth on the back of improving growth outlook. This positive commentary lifts Indian IT services stocks as well.
With Swiggy filing details for its IPO, we finally have enough information to see how it stacks up against its peer Zomato. While Swiggy appears close to breaking even on its food delivery business, Zomato scores on most counts.
Edelweiss arms sell over 6% in Nuvama Wealth via block deals. Group Chairman Rashesh Shah points further value unlocking ahead to pair debt. He expects the holdco's debt to halve in 2 to 3 quarters before they start incubating new businesses once again.
A drought in Brazil is expected to lead to a sugar supply deficit, and this is driving prices higher. The Indian food minister's comments on hiking ethanol prices and minimum support price only add to the mix. Sugar stocks climb in trade.
Hello and welcome. You're watching us here on Halftime Report. In case you're wondering what exactly is on, it is the boys, the Chartbusters, coming back to you at midday as well. And this at a time when we have the all-new CNBC TV18 app, where you have the world, the financial world, on your fingertips, on the move as well. I'm Manglam Malu, and over the next 1 hour, we'll put the spotlight on the QSR space. We'll decode whether QSRs are coming back in fashion. We'll also connect with Sridhar Shankar Raman of Multiples Alternative Asset Management to put the spotlight in the fund race, our new segment that we have. And we'll speak about a bunch of other things as well. Doing okay-ish for the market, just the way the first day of a new series should be. We saw a bit of a pop, and thereafter, because of the Nifty bank, the frontline indices have been dragged down around the flat line. Nothing really to worry about. Hi, Nigel. The market breadth looking good too?
Well, that's right, Mangla. Market breadth looking good. And in fact, the markets, I think the problem today is the Nifty bank is taking a bit of a breather. The last 1 month has belonged to the Nifty bank. But, today, in fact, that one is down closer under 170 points. I wonder, I have to say, par for the course after the kind of heady rally that we have seen. And keep in mind, last 2 sessions, towards the end of trade, you've seen a surge. You had the Nifty bank expiry that played out, which was beautiful. The markets came back in style, and yesterday the Nifty as well. So maybe some kind of consolidation ahead of the PCE data that we'll get from the United States later today. Let's tell you about the metal stocks, though. They have been buzzing in trade post the Chinese stimulus, and CLSA, they continue to remain optimistic on this space. They've given us a few details as well in terms of rationale and why they are so bullish. And the 3 top reasons that come up for you on the screen. One is they're saying that Indian companies are self-sufficient. They're also talking about the backward integration that we have of the availability of raw materials, whether it's from their own captive sources or whether it's in terms of availability of iron ore, of alumina, of bauxite, as well as of thermal coal. They go on to give us their preference on these stocks. And the top of the pick that they're talking about is Vedanta. That's the one they've been bullish on for quite a while. Tata Steel and then Hindalco. They highlight this point that if demand is really going to come back, then prices will move up. And these Indian companies will gain because raw material availability is there, and then you have the benefit of higher prices. So the spreads will improve as well. So that's the reason why they're quite bullish on Indian names. In terms of preference, they prefer aluminium names, but they're saying that they're seeing near-term support even for the ferrous names. They're flagging upside risk, but they'll get more conservative once we see enough evidence that demand's coming back. So explains why metals continue to shine in trade.
Absolutely, Nigel. The metals continue to do well in trade as well. We're seeing some traction coming by. Also some traction on a lot of these individual names. In the F&O space, look at something like an Exide that continues to do well. Remember, stock had been on a bit of a tear, took a bit of a pause, and thereafter now starts the new series with a bit of an up move. A 5% big move is what we're seeing on Exide at the high point of trade. Navin Fluorine is the other one which has moved higher as well at the high point of today's trading range so far. And Titan, we've been pointing out that, ahead of the quarterly update, usually we see some action on Titan, and this time around that continues as well. On day 1 of October series itself, the stock has moved to the high point of trade. But the sector of the day has to be the IT pack, and this after what Accenture reported yesterday, a fourth quarter performance which was strong and a guidance of 3 to 6% growth on the back of improving growth outlook as well. What this has done is lifted sentiment in the Indian IT services stocks as well. Hormas joins in with more details on that one. Hormas.
Certainly, and the IT index had opened significantly higher, though off the highs of the day, but yes, a sentimentally positive move from Accenture's results. $16.5 billion that the revenue that it reported, 3% higher in US dollar terms, 5% in local currency. And what they also had, the previous quarter, they had raised their FY24 guidance to 1.5 to 2.5%. That came in at 2% for the full year, so in the midpoint of the guidance range as well. For this financial year, for FY25, they're expecting the first quarter growth to be 2 to 6%. For the full year, they expect it to be 3 to 6%. Now, for the forex impact, they're expecting a positive impact of 1.5% on the upside for both the first quarter and for FY25 as well. And they are expecting to return $8.5 billion, up to that much in cash, back to shareholders. They've also approved a $4 billion buyback as well. Now, you've heard in the previous earnings calls from IT companies that demand has been lagging. This time around, though, Accenture has mentioned that there is clear signs of demand. The clients are moving from the proof of concept stage to a greater implementation of orders, and as a result of which they're expecting a healthy increase in its order book for FY25 as well. The IT companies did well overnight. They did well today as well, but slightly off the highs of the day. Morgan Stanley says that this guidance from Accenture does not point to any change in environment, but it does confirm the fact that growth will start to improve over the next 12 months. But this commentary that has come in from Accenture is neutral to slightly positive for IT companies. What Nomura said is that they are expecting the growth to bottom out in FY25, and the Gen AI opportunity continues to mature, and as a result of which they have buy recommendations on Infosys and Wipro in the large cap space and eClerx in the mid cap space, and they have a reduced recommendation on stocks like LTI, Mindtree, Infosys, and on LTTS as well. So overall, a positive impact on Indian IT companies. The stocks up and about in today's session.
Okay, all right. Thanks a lot for that, Hormuz. Well, let's shift focus to the sugar space. The government is mulling an increase in sugar MSP and ethanol prices. Let's listen into some key comments coming in from the Consumer Affairs and Food Minister, Mr. Prahlad Joshi.
एथेनॉल प्राइसेस के बारे में पेट्रोलियम मिनिस्ट्री जहां तक मुझे इंफॉर्मेशन है, एज फार एज माय इंफॉर्मेशन को जहां तक मुझे इंफॉर्मेशन है, दैट इज वो कंसिडर कर रहे हैं प्राइस हाइकिंग के बारे में. ऐसे मुझे इंफॉर्मेशन है. वो तो प्राइस हाइकिंग एथेनॉल का जो है प्राइस ज्यादा करना वो पेट्रोलियम मिनिस्ट्री देखते हैं. तो पेट्रोलियम मिनिस्ट्री सीज्ड ऑफ द मैटर. और जहां तक मुझे इंफॉर्मेशन है, क्योंकि आवर सी द प्राइम आवर मिनिस्ट्री इज द नोडल मिनिस्ट्री फॉर द एथेनॉल. इसी कारण हम पेट्रोलियम मिनिस्ट्री के टच में भी है. It is well under consideration. I am quite hopeful that this year production will be quite good because of the good monsoon.
Right, so those were the comments, and as a result of which we've seen all these sugar stocks buzz in today's trading session as well. So what does this mean for the business going ahead, the industry, and perhaps the stock prices? Vamakshi joins in to decode what was said by the ministry.
Well, a couple of things is what the minister has said. The first one being on the increase in the ethanol prices. Now, keep in mind that the ethanol prices have not been hiked since 2022-2023 ethanol supply year. And in fact, when we spoke to ISMA back in August, they had suggested that the cane juice prices could be hiked from 65.61 per litre to 73 per litre. B heavy molasses, C heavy molasses to almost 67 to 60 to 61 rupees per litre. And these are the ethanol prices made from these particular inputs. Apart from that, the second announcement that came through was on raising a minimum selling price. The minister said that they would also consider this. The MSP has, however, remained unchanged since Feb 2019 at 31 rupees per kg. ISMA in August to CNBC TV had said that CNBC TV18 had said that they've asked the government to hike the sugar MSP to 39.14 per kg. But how will this impact the sugar companies? Well, it's largely expected to be a neutral impact, and I say this because the current sugar prices are almost somewhere around that level, so not much of a margin push could come through if the sugar MSP is hiked. Thirdly, they also said that they would review sugar exports for the 2024 to 25 season, and of course he also added that this decision could be taken only after looking at availability as well as the production. But the production is expected to be good given that it's turning out to be a good monsoon season. In fact, ISMA had also suggested to CNBC CNBC TV18 earlier that the government may have room to export 20 lakh tons of sugar this year itself. The food minister additionally also said that overall blending this year could touch 14%. The government was also quite confident of achieving 20% ethanol blending target by March 2026. And in fact, the food ministry has written to Niti Aayog to prepare a roadmap for increasing the target of ethanol blending to almost 25%. And this in turn provides some fillip to the ethanol sales volume. So overall, all of these announcements indicating a positive stance for the sugar stocks. And as a result, all of these counters are surging in trade today.
Making a sweet move, so to call it. Vamakshi, thanks a lot for joining in, always on top of her game. Well, let's slip into a short break, but do note we'll get you excerpts of a conversation with the management of Triveni Engineering on Commodity Corner at around 12:45 p.m. later on in the show. Let's also slip into a short break. We'll continue to focus on markets as well as on the QSR stocks. Don't go anywhere. Welcome back. You're tuned into Halftime Report. Well, let's focus on a couple of stocks that are moving around in our Value Plus segment. Mangalam is turning the attention to the QSR space. Mangalam, good to hear your view on some of these stocks. I hope
but
lunch
even
is
better to eat a pizza and perhaps some burgers. Yeah, let's see how that goes. It's a Friday. I mean, why not? I'll get some pizza. But, it looks like in the movie business, you have sleeper hits, right?
Yeah.
It may look like this is a sleeper hit of the last 3 months or so. Why do I say that? Because from the lows, we've seen a big rally in a lot of these quick service restaurants, stock prices. And look at the last 3 months itself. In the last 3 months, Jubilant FoodWorks is up 26%. We've seen a near 26% rally in the share price of Sapphire as well. Devyani is up 23%. Restaurant Brands and Westlife are underperformers out there. Westlife, after today's up move, is actually up 10% in the last 3 months. What is exactly happening out here? There could be triggers for demand improvement. Why do I say that? Because one, inflation is contained, both on the raw material front and also for consumers. Once inflation is contained, then they can have that extra income to go ahead and spend on QSRs as well. A lot of these companies have gone ahead and expanded their footprint into tier 3, tier 4 cities where there hasn't been much presence of QSRs. So as soon as a new place comes in, the propensity to consume there is extremely high. Thirdly, all of last 4-5 quarters, these companies have been reporting negative same-store sales growth. So there is a favorable base scenario that we're getting into as well. And now post-COVID, what has happened is delivery and takeaway has become the preferred route of consumption in major markets. So these guys are, making their stores more amenable to delivery and takeaway as well. And they are also at the same time taking steps to revive dine-in through offers. I remember Domino's having a 99 rupee lunch offer if you are dining in. And that's what the management had told us as well, that they're looking to arrest the decline in dine-in while they're growing stores as well. And we've seen signs of recovery out there too. Domino's like-for-like growth, if you look at it, the last 5 quarters, 3 of them have been negative, one largely, flattish, and the last quarter we saw an improvement of about 3%. Even if you look at McDonald's, while there has been a bit of a decline, it suggests that the base going forward is getting a lot more favorable. And that's what Goldman Sachs is betting on for McDonald's as well. They are saying that, there is time for them to upgrade the stock to buy with a target of over 1,075 odd rupees. They say that the recent launch that the company has done, McCrispy, is a key catalyst for recovery. Why is that? Because remember, 10 years ago, they had started a new addition called McSpicy. So you had McSpicy Paneer, McSpicy Chicken, McSpicy XYZ. So it's the first new core addition that has come in the form of McCrispy. Truth be told, I tried the McCrispy Wedge. It could do a little better. I think I would await your comments on the McCrispy Chicken to tell me whether, crispy chicken will do well or not, largely given the tailwinds that we've seen in chicken sandwiches as a category as well. And globally, McDonald's is actually focusing on the chicken category, and that should help Westlife as well. And they expect the SSSG to start recovering in the second half, aided by a softer base, and they forecast high single-digit SSSG for FY26 as well. And it's not limited just to burgers. Jubilant FoodWorks as well. The management was recently at the Jefferies conference, and they said that the industry itself has started to grow once again in volume terms. They're focusing on growth through innovation, marketing, tech infra, and their own delivery feed. So, with Zomato and Swiggy coming in, the big moat for Jubilant FoodWorks will be their own delivery feed. So that really does well for them. They see large headroom for store expansion. And speaking about chicken, once again, it is 50% of the CEO's time is spent on scaling Popeyes the right way. So they're looking at Popeyes as one of those growth parameters. So you have KFC doing well, McDonald's focusing on the chicken sandwich category, and Popeyes also scaling. So for those who eat chicken, this is a good time. And if you look at the valuations as well, they've never been particularly cheap, but 2 years forward and 1 year of underperformance may have made them a little more favorable. Westlife 29 times FY26 EV to EBITDA, Jubilant Foodworks 26 times, the others trading between 16, 19 for restaurant brands, and Sapphire, Devyani at 24 times as well. So the question is, are QSRs looking to come back in fashion? Is this going to be the sleeper hit of the second half of this year?
Lovely. Thanks a lot for that, Mangalam. And I look forward to the crispy, burger, sandwich, or pizza, whatever else you want to treat me to. But let's focus on Newland Labs. That one's surging in trade. What's causing the move? Vinny is taking over. She's here to tell us about exactly why. Vinny, take it away.
Yes, the Newland Labs is buzzing in trade today. Now, US FDA has actually approved BMS, that's Bristol Myers Squibb's schizophrenia drug. This drug has a market of around $2.5 billion. Analysts are expecting this sales to be of $2.5 billion by 2030 in the US market. So, big drug clearance that BMS has gotten. And on the back of that, we're keeping an eye out on Newland Labs. Why? Because Newland Labs is expected to be the API supplier for the drug. What analysts are highlighting that one has to wait and watch that whether they are going to be exclusively the API suppliers, or maybe there may be a combination of other suppliers with that. But surely a positive for Newland Labs, because they are among these suppliers for complex drugs, and they would be a part of this, a big market that comes in from the BMS side. And in terms of the US market, list price is expected to be at around $1,850 a month. So interesting to watch out for this one.
All right, take that point, Vinny. Thank you so much for that. So that's about Newland Lab in focus on account of the schizophrenia drug. But Sequence Scientific is too in focus on the back of a merger announcement that is coming with Viyash Life Sciences. So Vinny, what does this do, and how does this change the things for Sequence Scientific?
So yes, so this is a big merger that is coming in between both the companies, that Sequent as well as Viyash Life Science Private Limited. Animal healthcare side, the focus comes in. So this, once the merger entity comes, it will be a huge player in this industry. So let's talk about some of the internals. Swap ratio, if you're holding 100 shares of Viyash Private Limited, you would get 56 shares of Sequent Scientific. And from Sequent Scientific would be the listed player on other exchanges. What is the rationale behind this? Because they want to create an integrated business, a large research and development in-house facility, manufacturing facility. So both these merged entities, when you look at it, the merged entity would have a 5 times higher manufacturing capacity, almost 9 times higher in terms of the US FDA approved facilities, and 8 times higher in terms of the product filing. So that increase in terms of business obviously comes in on that front. And from the first day itself, this would be margin accretive for Sequent Scientific. So talking about the financials, Q1 FY25, Viyash managed to see around a revenue of around 340 crores, while Sequent was 390 crores. So combined entity will be almost double in terms of revenues. Margins, margin accretive, like I mentioned, because Viyash has a margin profile of around 17% is what they managed to gain even in the last quarter. That's Q1 FY25, and that would be interesting to watch out for. But yes, leveraging the balance sheet for Sequent Scientific, that's an important one to watch out for. Margin accretive for the business. So that is why Sequent Scientific as a stock is also trading almost near its 2-year high levels.
Got it. All right. Thanks a lot for that, Vinny, for joining in and giving us the details on why those pharma-related stocks are buzzing around. We'll slip in a short break. On the other side, Apurva Sheth of Sampo Securities is waiting for us.
Welcome back. You're watching us here on Halftime Report on CNBC TV18. A lot of stocks doing well as we speak. The oil marketing companies, they should come up for you. BPCL has moved to the high point of trade. A bunch of others as well, spiking. And just keep an eye at the bottom of your screen as well. There is a CNBC TV18 exclusive which says IPO-bound Bharti Energy's listed arm, Bharti Renewable Tech, eyes Enel India's business. So we'll keep an eye out on this story. Get the correspondent on this one as well. Rachna is joining us shortly to tell us more about it. So what we know is that their listed arm, which is Bharti Renewable, that should come up for you, up around 3% right now as we speak. If you look at the last 1 month or so, it has seen a bit of a rally already. Nearly 30% up move is what we've seen. Their listed arm, Bharti Renewable Tech, eyes Enel India's business. This is Italian Enel Group, a renewable energy company, which is looking to sell its renewable energy business in India for about $300 million to $350 million itself. We'll shortly go to Rachna right now, because remember, Enel India has a portfolio of 760 megawatts in terms of capacity in Nigeria.
There's some good news. Rachna's with us. Let's hop across straight to her. Rachna, tell us, what are you picking up in terms of this big news break?
Right, Nigel. Sources have indicated that Bharti Renewable Tech, which is a listed arm of the IPO-bound Bharti Energies, is looking to acquire Enel India's stake. Now, Enel is an Italian company which has an India arm called the Enel India Green Power Company, and they've been looking to sell their stake in it. And now Bharti is looking to throw their hat in the ring to acquire the stake. This transaction is estimated to be valued between $300 to $350 million. But why is Bharti Renewable Tech interested in buying is the question. And answer to that is Enel has about 760 megawatt peak operational assets, which is a mix of solar and wind, and this would give Bharti a leg up by providing them an IPP, which is an independent power platform, which is very much the need of the hour for Bharti at this point, because they have been an EPC company, which is engineering, construction and procuring of assets, and they right now are present in the solar segment. With this acquisition, if it gets through and if they're successful to acquire the stake, they would get a leg up definitely to become an IPP platform and to foray into the wind power assets as well.
Okay, all right. We'll keep an eye out on that. Thanks a lot for that. Rachna is doling out the exclusive in the last few days, so we'll keep an eye out on that one. Well, let's get in Apurva Seth of Samco Securities, who joins us to help us out with some trading strategies. Hi, Apurva. A while since we spoke. What's your view on the index? The Nifty Bank is taking a bit of a chill pill on a Friday. Your view?
Hi, thank you for having me on the show. So my view on the Nifty is that it's been moving in a strong uptrend, but now it's hitting a channel resistance. So I expect some sort of a consolidation to kick in for the next few days, and before it again moves higher. So our immediate view is that the Nifty index can stay sideways, and any dips towards 26,000 levels could be used as buying opportunity, and 25,850 would be the stop loss for this trade, and on the medium term the target would be 26,600. so that's the view on Nifty. Bank Nifty is also having a similar setup, so 53,800 to 54,500. That's the immediate short-term range that we are seeing consolidation happening in Bank Nifty. So once this consolidation is through, we can see again a breakout on the higher side. So apart from this, the stocks are Petronet LNG. So the stock has moved up nicely to 380 sort of levels, and from there it has corrected back down to 320. So 320 is the range where 120 EMA support is placed, and so that would be my stop loss, and the target for Petronet LNG would be 370. Apart from this, there's another stock which is EID Parry. So sugar stocks are in momentum currently, and EID Parry owns about 56% stake in Coromandel International, which who has a market cap of about 50,000 crores. So all this put together, sugar as well as the holding company theme, and there's a price and volume breakout happening today. So all of this put together, the stock looks like it's ready for an further upside. So my immediate stop loss for EID Parry would be 815, and target would be 950 plus.
All right, we take that point. Thank you so much for joining in and giving us your views on individual stocks, etc. We'll let you go on that note. Take a short break, come back. We have an interesting discussion lined up for you. Sridhar Sankaraman of Multiples Alternate Asset Management joins in to decode the consumer space investing in our special segment, Fund Race. We keep getting you PE voices, and today we have Multiples.
Welcome back. You're tuned into Halftime Report. Well, let's get you some opinion we got earlier today. Edelweiss Arm, they've sold close to around 6% stake in Nuvama Wealth via some large trades. Earlier today, we had the group chairman, Mr. Rashesh Shah, in a rare interview. He points to further value unlocking ahead to pay down the debt. He also expects the holding company debt to come down by half in the next 2 to around 3 quarters before incubating new businesses. Let's listen in to what he had to tell us.
This, whatever the 14% was held, approximately half of that, at least actually slightly under half of that is what we have sold today, morning. This stock, Nuvama got listed a year ago. So we had a 1-year lock-in on the shares, so that got over. And as you know, we in Edelweiss are making investments in our asset management and insurance businesses. But along with that, we also committed to reducing debt. So we are also paying the debt at the holdco level. So this inflow will also help us reduce our debt. The overall group debt come down significantly from a peak of close to 50,000. We are now down to 14,000. So we lost 75% of the group debt in the last 4 years. So we continue on that journey. We are in no hurry to exit. So I think Nuvama, we are very bullish on the wealth management space, as I said, asset management space. So though we have a 75-day lockup, we are not in any hurry to exit the balance. We will just do it as per that. As you know, Edelweiss as a holding company, as an investment company, we have our own priorities. Our holdco debt was about 8,000 crore. So this reduces it significantly. And we have a lot of other levers. We have quite a few other investments. Our idea is to bring the holdco debt to half.
Welcome back. You're watching us here on Halftime Report. This is our special segment, Fund Race, the PE corner on our show. And today we have with us Sridhar Shankaraman, who's the managing director at Multiple Alternate Asset Management. Of course, they have about USD $3 billion in AUM with about $200 million to deploy in the consumer and consumer tech space itself. Sridhar, always a pleasure speaking with you, this time more so because it's in our studio. The obvious question is, you have $200 million to deploy. What is the environment looking like, especially when it comes to valuations, the parameters you all are tracking, and where is the opportunity?
So, Bangla, we look at opportunities in about 3 or 4 buckets, right? So we look at assets which have a leadership position or an ability to become a leader in a large market, because we always know that leaders get a different premium over the second or the third player, right? We like businesses which have a high gross margin pool, companies which have an ability to expand to the adjacencies, and businesses which have demonstrated customer love. I mean, compounding revenue is one, but compounding love is what creates long-term winners, right? I'll just give you examples. We were investors in PVR. Ajay Bijli made sure that people paid 2x the premium to watch the same content because of the experience that he created. We were investors in delivery, right? I mean, Sahil always priced himself premium to that of an e-com express because people wanted to pay for that because there was consistent supply. We are investors in Licious. It's much more expensive meat compared to the fresh market, right? Because people are happy to pay the premium. That is customer love. And in our experience of investing in consumer, we have seen that founders who are able to compound consumer love are the ones who create the long-term value.
So which are the founders right now where you see love being created? Because love is great. You just rearrange the words and put an A out there, it turns to value. That's correct. What matters in the stock market. So tell us more.
That's true. So see, if you just look at the Indian consumer, right? I mean, all of us in the room, right? We care for 3 things. The 3 C's. We care for cost, we care for convenience, and we care for catalog. So Indian consumer, therefore, is demanding, aspirational, and value conscious. So we want the best of everything, but we want it at a price. right? And therefore, there's an Indianization to what type of businesses will really succeed in this country, right? Also, we have a misnomer, Mangalam, right? We keep saying we are a billion people, but we are not. We are 80 to 100 million small tribes because our taste, preferences, everything changes, right? And which is why we have so many regional brands. So brands that have been able to overcome these two are the ones who are able to command a certain value because it's so hard to create a consumer brand in this country. And that's why markets value them the way they do, because there's a huge terminal value. Because brands in this country, once they're built, don't die, right? So that explains the high valuation that we have. But I believe, Mangalam, that there is an arbitrage in the private market versus the public market. Private market, you're still able to get some of these brands at, I would not call it reasonable, but I would just call it, in terms of closer to the fair value. Then what you can, and then the whole game in the last 10 years, if you look at private equity invested brands, the value creation has happened less from growth, more from multiple expansion. So invest in these companies, look at 300, 400 crore brands, take them to 1,000 crores, and then look to list. Has been the game which has been created value. So I would say in private market, there is still opportunities.
All right. Hi, Sridhar. Good to have you in the studio. A quick couple of questions before both you guys bond on the consumption theme. Wanted to ask you about PVR, since you mentioned, just to clarify, have you all totally exited?
Yes, we have.
Totally exited. Arvind?
Exited.
IEX?
Exited.
RBL Bank?
Exited.
All right.
So all the listed spaces are exited right
So
now.
that's out of the way. Since we're talking about primary and secondary market, what's the view on Zomato versus the Swiggy argument? Tell us about the space, without getting very, very specific.
Sure. See, one of the big trends that we are seeing is brands in India that are solving an India-specific problem will definitely create value. And not necessarily brands which are a cut, copy, paste of what has worked in China or what's worked in the US. I'll give you an example, right? A lot of buzz on social commerce 3 years ago. Right? That's not worked in India so much because we are not a tipping culture. Right? It's very difficult to replicate something which has worked somewhere and say, hey, this is going to only work in India as well. Quick commerce has not worked in many places in the world.
Right.
So why does it work in India? It works in India because of 3 reasons. One is the rider cost is very reasonable because the cost of human labor in India is much more. The density of people is very, very high, right? And third, people value anything which I said goes to 3 C's, cost, convenience, and catalog, which is what quick commerce is able to offer you, right? So quick commerce is a very India-specific phenomenon as much as a global phenomenon, right? I think the big, what has really worked for Zomato or Blinkit is the average order value. Right. The average order value is you have to make money on every order. If your average order value is what it is for Blinkit, so it's close to $600, your fixed cost is the same. The cost of the rider is the same. Right? You are still able to make money off that, right? So I think whoever is able to crack a higher AOV or higher average order value will be able to create value over a longer period of time.
That will be a function of the assortment itself, right? As the assortment itself
the fact
is
that people
broadening.
are selling iPhones on quick commerce tells you the kind of AOVs that one can aspire for. I mean, who would have thought that one would buy an electronic item?
Totally. But what is the future for QCom in India? I mean, you have Blinkit, which is expanding extremely fast. You have Zepto, which is raising money extremely fast and at higher valuations as well. Then you have all the others as well, looking at, either improving their assortment, growing. So where does it go? Is it a monopoly with small players? Is it a duopoly? Is it one large player with many regional players? How does this space pan out? What does a mature QCom market in India look like?
So the way all these 3 players began is regional. Zepto was very strong in Mumbai. Blinkit was very strong in Delhi and maybe Calcutta. Swiggy was very strong in Bangalore. Right? That's how they initially began, and then they entered each other's markets, right? Even within pin codes, you'll see that Mangalam, in your area, maybe one player might be a lot more popular than the other. In my building, one player is more popular, depending on who has got the darker store closer to where you are, right? It's ultimately about speed and ultimately about assortment in that area, right? If a particular area belongs to one particular community, if you're able to, so it's a very, it is still a micro market game in that sense, even though in the bigger sense, it's almost like merchandising in a kirana.
Got it.
Quick commerce is a glorified kirana, right? For the lack of a better word, right? And you have to merchandise in every locality. You cannot sell what you sell in Matunga to what you're really selling in Malabar Hills. I believe quick commerce today is, if the Indian retail basket is 1 trillion, quick commerce is still a very small fraction. 10 years from now, I believe it could be a very, very large opportunity.
So there's still value is what the short point is.
Nigel.
Okay, all right, Sridhar, we'll have to thank you on that note. Appreciate you coming down and detailing all your thoughts. We look forward to chatting up with you more often as well. Thanks
Thank you. Cheers.
Thank you.
Well, time to slip in a short break. You come back, we'll get you excerpts from a conversation we had with the management of Triveni Engineering in the commodity segment. Stay with us.
Back, you're watching us here on Halftime Report. Let's get to the sugar space. The Food Minister Prahlad Joshi recently announced government's plans to increase sugar MSP. We heard Vamakshi talk about that. But our colleague Manisha got up with Triveni Engineering and Industries, the MD, Tarun Sohne, and started by asking them about their strategy to adjust to the changes in the category that may come about. Let's hear out that excerpt of exclusive conversation.
We at Triveni have really tried to encompass all of these changes. First and foremost, we have expanded our distillery business quite substantially. We have 5 operating distilleries just now, and about 50% of our production is multi-feed. So we've tried to encompass all aspects in terms of using grains, rice and maize, or even sugarcane byproducts like molasses or juice as well. That is really to ensure that we can get the maximum value at any particular point in time. As you know, all of this is policy driven. We have different pricing levels for ethanol made from different constituents, and therefore nimbleness is actually the essence that's required today, and we at Triveni have tried to incorporate that in this business.
As you add more and more products and ingredients, it's also about supply availability and then about price volatility. How are you dealing with that?
Fantastic point. You know, we've seen that pricing gets, of course, decided, end product pricing gets decided by the central government, but that has an immediate impact. So things like maize, for example, where prices have been increased twice over the last 12 months or so, that price advantage has not actually factored to the industry. It has been absorbed by the trade. I actually would go on a limb and say that the benefit hasn't even come to the farmers. They have been paid the MSP, and the area in between has actually been captured by the trade. So it's unfortunate. We need to find a mechanism where the farmer benefits, and at the end of the day, it allows industry to earn a reasonable rate of return so that there is more investment. And investment is absolutely critical. Today we're standing on about 1,300 crore litres of production of alcohol in the nation. We need that to go up to 1,700, 1,750 in the next 2 years. So there is some headway. 20-25% of additional investment is essential to be able to meet that 20% blending level that the Honourable Prime Minister, the target that has been set by the Honourable Prime Minister. And I hope that we'll be able to do that. It's a combination of pricing, policy, and then, of course, investment by the industry.
Going forward now, the government to begin with is looking to increase or revise perhaps the ethanol prices, which has been delayed. Sooner than later is what that needs to be done. So what's your sense on how much higher the prices need to go from here to ensure that it's profitable?
Oh, that's $1 million question. No, it is profitable already. Let me be very clear about that. However, I think we need to return to the levels of profitability that we had, say, 2 years ago, 3 years ago, and before that. Last year, there were other challenges that impacted the economics as far as ethanol was concerned. I don't think those considerations are there today. And so my hope and expectation is that over the next couple of months, let's say 6 to 8 weeks, 6 weeks more like it, we will have definitive policy, definitive pricing changes, all upwards for all the various constituents. So from maize and rice, as well as bee molasses and cane juice and sea molasses, all moving in a positive direction. I'm very hopeful that this will actually lead to more clarity as we get into the third term of the BJP government.
Tarun, one final question. And even as there are investments and there are capacities being increased, as you mentioned, you yourself have been increasing the distillery numbers that you have. What is the sense about consumption itself? Do you think that is one factor that still needs to be addressed on large?
I don't think so. I think we are on the anvil of something quite incredible. We've reached 15% blending last month. The average for the year is about 14%. So by and large, what the government had envisaged. Next year, the hope is that we get to 18%. And when I say next year, the year starts 1st of November. And then the following year, 20%, as has been envisaged by the Honorable Prime Minister. But beyond that, and that is, I think, what you are getting to, the real opportunity lies in E95, which is really going to increase the bandwidth of this industry by a substantial quantum. And at that point in time, the requirement of distillation capacity will go up many fold from where we are today. So it's very, very exciting. The hope, of course, is that all of these things do happen, because we will see ethanol becoming an absolutely enormous sector and an important contributor to the Indian economy. And of course, what's most important is that it will be the first true source of energy that is coming from within India, because we, as you know, import most of our energy requirement.